All right. All right, so this is a gap down of all the Australian dollar on a 1 hour chart, right? A 1 hour chart, it's actually, it's a big chart. If actually gapped here to this, to all the way down, you must actually know that if you take it to go recover the gap to fill the whole gap, you're gonna make a good profit, because definitely it has to, no matter what it takes, but it has to come and fill this gap all the way up, fill the price, fill with the liquidity all the way up, and then that's where it's gonna now start having the decision where else the market is actually going. All right, so that was for gaps. Any question for gap before I get into two things about the slippage? Any questions so far about the gap? Or did we actually get it? Did we understand? Anyone who say, I didn't get it, I'm not understanding what exactly you are talking about. Anyone? Yes, Mr. Timane, I can see you are typing there. Is there anything that you didn't understand?
Yeah, I think, I don't want to take you back, but yeah. I wish I could get the video, because I can see you recording.
Yes.
The video of this lecture, because I think there are some things that I did not understand with regard to the gap, especially looking at the illustrations that you presented just before the last one.
Yes, this one.
I did this one. Yes, this one. I did not understand, because it gaps here at the bottom, and then it opens at the top, and then it goes up and comes back again.
Yeah.
I'm not sure what does that mean. Does it mean if it goes down again, there's I'm not sure. Am I losing or am I gaining?
Okay, all right. So just a simple explanation before we go further. If you see this instrument, the Euro JPY, it was going all the way down. This was a downtrend, all the way downtrend. So if you were selling from top here, from on top, you click sell, right? Selling, it means bearishing. Buying, it means bullishing. Njengenkomo, the way they put, they always like to put inkomo there. When it says it's bullishing, it means it's buying. When it's bearing, it's pointing, all the horns, they're pointing down, right? So now if you open a sell here, you could have collected the price, you could have been making money, all the way making money. When it get to this level, that's where the price, the trend end, right? It ended here. Now, again, I'm sure you have a question, the reason why it ends here. There's a couple of things that actually show that this is the end of the trend, right? First of all, you look at your resistance. Did the price get to the resistance? Did the price get to where it turned before, right? Remember, a zigzag, but it tends somewhere to go up. Did the same price, did the same position tend before? Yes, it turned before, maybe 4 days ago, or 10 days ago, or 3 weeks ago, it turned at the same position. It actually means it is possible to actually turn from here, resisting from here, and changing the direction. Number two is the candlesticks. Can you see the candle, a hammer candlesticks? A hammer candlesticks actually identifies the end of the trade, the tiredness of the trend, where the market is going. Actually shows that the market, it's tired. And you can see there's a hammer here, right? There's a hammer. It's in the red, but it pulls the price all the way back up and have something on top. it actually says that the market couldn't go all the way below, but the price has to push it up. So the possibility people are starting pushing up. Now it turns now because of those signals. We see it resist at that position before. We see the hammer, then it turned. Then if you were selling, you close your trade. Immediately you close the trade, you see these signals, you said, okay, let me buy. Now you are buying. If you are buying, you are making money. Immediately it gaps from here to there. You actually make more money. You make more money because of now it moves from one price to another without you waiting for it to move bit by bit. It actually jumps fast, right? If you're on the same trade, you actually make a good money. But again, it is an indication to say that the price will come back and fill this money. So it's like someone gives you money, but is going to want it back. So it's up to you to keep that money away so that it shouldn't take it back from that. So if you, let's say you're still buying here and you forgot about the trade, or maybe you went somewhere, you'd be like, no, it just kept, it will continue buy. Eventually, the price need to come back and fill that gap. And immediately, if it's filling that gap, all the money that you make from this, they all come back. Everything is all coming back. Now you are sitting on a zero now, but you've been holding the trade has been on the profit, instead of when you see the gap, gapping up, whether if you are selling, you close the trade, or if you are buying, you close the trade. The reason why you're closing the trade when you are buying, because you know eventually it will come down to fill that position that will leave the space. The reason why you are closing when you are selling is because of it already moves a little bit above for you. Now it will always depend on, do you have enough money to hold it until it fill that gap? If you do have enough money, traders, they leave the trade like this. It gaps up, you are selling, you must just be patient. As long as you have enough money, it will come back and recover at that position. I don't know, sir, did I clarify it better?
Yeah, I think you did. I think you did.
Okay.
But maybe just one last question.
Yes.
You said the part, this gap filled. Mm-hmm. Explain that part again first for me. I'm not sure that I understood you.
This one, the one that said gap.
Yes.
filled.
Yes. Yes.
You see here, there's space. There's nothing, right?
Yes.
It actually means there's no liquidity. There's no one who has money involved in this place. So it pushes the price from here to get to this level, because that's where there's people having positions, the orders to trade, right? But the rules of the gap is that once it goes up, because of there was no liquidity here, it will need to come back to fill this position. So to fill, it's like coming back to the same position where it was before it actually start making another decision. Because this, it's called a force movement. It forces the price from here to jump to there. Now the force movement, it has to recover automatic event, like that's how the Forex market it is. Once the force movement happens or a gap happens, it eventually come to recover, to replace them. So that is why we are saying it is a signal. When you see it gaps, you can actually think, oh, okay, what was the past price where it gapped before? Oh, it was on a 200. It gaps to 400. All right, that means eventually it will go back to 200 position. Then you can open a position from the top, preparing, putting a take profit around here, saying that once it get here, it recovered, you make your money, you're out of the market. All right, don't worry, the video is always there. The video is always available. I'll be able to send it to you once on Monday, once we're done with everything. So here it is, this is gap down, same analogy, gaps down, comes all the way down, start all the way up, filling the price again, going all the way up. It was up, pushed the price. There was no more people who are actually having the sell. A lot of people having a buy position at this level, maybe because of it was resisting at here. Now they decided to have a position ready here, so that when the market comes here, it will trigger the position and goes up. Now it gapped. After it gapped, it started recovering all the way up. All right. Okay. Now we're gonna jump in a little bit, talk about the slippage. Just a small, thing about the slippage. The slippage is the difference between expected price of a trade and the price at which the trade actually executed, right? Same thing, it's the same as a gap. The market gaps can cause a slippage which may affect a stop and a limit order, meaning they will be executed at a different price from that requested, right? Okay, again, let me get back to here. So you open a position here, right? And now it gaps. When it gaps, your position didn't trigger because of there's no, let's say you put a stop loss. Let's say you open the position from the bottom. You said it's gonna come around here. Let me put a stop loss here. But because of there was no liquidity at that particular time from that position, the market jumped from your stop loss to above. You find out now it's stopping you above the price, above your stop loss. And a lot of people, they get worried. They said, why the market is doing that? Some people, they think it's a manipulation of the market. Some, they think, what is going on with this broker? But it's because of caused by the gaps. The gaps now cause the slippage, the market to slippery to another position. So if you have a take profit, you put a take profit somewhere around here. If it gaps, because of there's no liquidity, it will close your price at this position. And now if you close the price at this position, it will work on your advantage because it closed above to the position that you say it should close. But now, if you are saying it's a stop loss, it will work against you because now there's no liquidity. It will close above that price you said it should stop. Now you're going to have a little bit of more loss. So those are called the slippage. The slippage actually occurs because of the gaps, and it's actually, meaningly they will be executed at a different price from the requested price. So you request at 100, but your position is being requested at 110 or at 105 or at 120, depending with the price. So that's the slippage. A young guy there slipping around. Here it is. So if you can see the chart, it's the same gapping to this price. It gaps 181 pips. So from here to there, there's 181 pips that actually moves from here to there. That's a lot of money if you actually get, this position, or you actually, get it from here and it gapped while you have a trade open, right? If you have a stop loss somewhere around here, you must know that it will slippery above the gap that you actually, the space that actually has at that particular time. It will slippery above, and now it will end up closing you above the price, and you might actually, have a bigger loss. Okay. All right. Again, the slippage in Forex tend to be seen in a negative light. However, this is normal. The market occurrence can be a good thing for a trader, where the Forex trading orders are sent out to be filled by the liquidity provider of the bank. They are filled at the best available price, whether the fill price is above or the fill price it's below requested. So remember that what we are trading, we are actually trading a liquidity from the banks. So if the bank says we're not going to fill the liquidity at position A, that means you fill the liquidity, they will fill the liquidity maybe at position B. That means your position, it will be triggered at the position B. One of the examples of the Forex slippage, the outcome, it's negative slippage. So you can find things like a negative slippage. The order is submitted and the best available by the price being offered suddenly changes to 1.3660, 10 pips above requested. The order is then filled at this price at 1.3660. Anytime we are filled at a price different to the price requested on the deal ticket, it is called the slippage. All right, what causes the slippage, right? So how does the Forex slippage occur, and where can our orders be filled at our requested price? It all goes back to the basic of what the true market consists with. So the true market consists with the buyers and the sellers. There's people who are buying, there's people who are actually selling. For every buyer, the specific price and the trade size, there must be an equal number of the sellers at the same price and the trade size. If there is ever an imbalance of the buyer or a seller, this is what caused the price to move from one position to another. I don't know if you get me there. It's actually when in a market there's buyers and the sellers. When the buyers open the position and the sellers open the position, the liquidity provider, they had to make sure that there's the same level of these. There's same orders of the buyers and the same orders of the sellers. The one more order that will be above the other, it will start changing the direction, going to another direction, which is the knowledge that we can't know that. We won't know that there's millions of people that are actually, having the sale. But there's a website that you can go on. That website, it tells you how many banks are actually saying this instrument is going to be selling. How many banks are saying this instrument is going to be buying? How many banks are saying gold is going to be short? How many banks say gold is going to be, buying? To that instant, if you go to that to look on that, website, you'll be able to see that, okay, all right, there's 4,000 people, 400,000 banks that are saying it's a sell, 10,000 banks that are saying it's a buy. Pretty much it might go as a sell because the higher majority of liquidity provider, they are saying it's a sell. So as a Forex trader, if we go in and attempt to buy, maybe for example, 100K of euro, okay, this is example. If there were a flood of people wanting to sell their euros at the time our orders was submitted, we might be able to find a seller willing to sell them at a price lower than the price that you actually submit as an order. Then what we had initially is requested given as a positive slippage. Are we together on this slippage thing? Okay, any questions? This is it. Let's do the question for a few minutes. Anything so far? Okay, let me just get in a chart for a few minutes or so that we can see these things. Okay, Nasdaq. Okay. Can you guys see the gap? Small gapping there. Okay, let me try to indicate it right. Shape. Here we go. That's the gap. Now look at what the price did. Drops down and then start collecting the price and shooting up, recovering the whole gap that happened on this. So we look at US30. Exactly at the same position. It gapped. Gapped from here to there. It means there was a little bit of there's a lot of orders that were opened at this position, and these orders, they were buy order. But at this moment, there were few people that are pushing the price to be a sell. Now, because of the way just few, and it gaps to get the guys that they were saying that it's a sell. I mean, it's a buy, hit their orders and recover. So from this distance, already you can see it has recovered. From here, it has recovered with this candlestick, this gap. So always it's an indication to say that now it's going all the way up. Now I'm going to show you the stocks. People who normally trade stocks. For example, this is Apple. Here's the gap. Here's the gap. Remember, it says the stocks gaps all the time because the market, when it closes, they are not actually, working. So yesterday it closes here. If you knew that actually, today when it will open at this position, here's what will happen. It jumps all the way, gets to this level. This is actually a signal for a trade because it will eventually come back and fill here. Look at what happened here. It gapped all the way down, but eventually it come back, it filled this space. So this trade, no matter what, it has to come the least it can to this position. The least it can do is to come to this position. If you go on a bigger time frame, maybe 30 minutes, 15 minutes, you see the gaps, they are all over. Gaps there again, it gaps here again, gaps to this side, comes all the way drop, picking up again, filling the position. Gaps here again, goes the way up, gaps to drip to fill up the position. Let's look at another stock, Alibaba. Same thing, gaps, gaps. We look at Facebook Inc. Facebook Inc., same thing, gaps. That's a lot of huge gap, this one. This one looks like it's a huge, big gap from here to here. That's a lot of pips. Let me see. That's actually 158 pips. 158 pips. So gapped from the 158 pips. If you were selling here and it drops to this position, you could have made a very, very good, profit. And then all the way started going all the way up again. All right, ladies and gentlemen, thank you very much. That's what, I actually prepared today. But maybe let's just do one more instrument to analyze, to do the technical analysis. So every day when we're doing this session, we're going to end with one analysis of the instrument to see how it's going to, take us to. Any trade, any instrument that you think we can do? Any instrument? Any trade that we should analyze, guys? NAS 100. NAS 100 doesn't respect a technical analysis, my brother. We can do it, but anytime when the market change or when there's a news, it's not going to respect at all. So it's actually, I don't like analyzing NASDAQ based on the technical analysis. What else can we do? We can do it, but well, it can change. So it only gives you the first education, because if you do analysis another day and you find out it's not going on that direction, you see that it's different. It's another thing. Anything else besides NAS 100? Okay, let me just choose anything. Okay, let's see gold. Yeah, let's jump on gold. And maybe we can try to look at gold. Here's gold. Now, as always, all the time when you're doing the technical analysis, we should always start with a bigger time frame. So what we are looking here is looking at a bigger time frame. This is 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hour, daily, weekly, monthly, right? So we're gonna go on a daily time frame. So first of all, I wanna remove all these lines that I was doing before so that it can be clear. All right, now we have deposited our $100 or $200 in the market, and we wanna know, where the market is actually, going, and how can we analyze? So we come on a daily, we see that the market has dropped all the way from up to down, but it started picking up all the way high. Now, the first thing that you should identify is to identify what is the highest point of this trade. If you look at the highest point of this on a daily, it was on $2,068. That's the highest price of this instrument, all right? The second thing, let's look at the second highest price of this instrument. So you look at the second highest price. Okay, yeah, here we go. It's sitting at 1,994. 1,994, that's the second highest price. All right, let's go on a H4. So we jump, got in a little bit smaller time frame so that we can do it during the day. We cannot see the highest until we scroll all the way back. That's where you can see the highest of the price. Now we have to identify another highest from H4. We identify a second highest on H4. We identify a second highest again on a second highest from H4. All right, now we know this is the highest, this is the second highest. Let's identify the lowest point. This is the lowest point. Let's identify the second lowest point. This is the second lowest point. Ladies and gentlemen, this is very, very easy to do these things. It's just knowing the highest and the lowest, the second highest and the second lowest. Now, we come here, we draw a trend line because we want to identify what trend is it going. What exactly can we, do the day trading in which trend? We click a trend line, we draw from the lowest to the highest at the present, right? From the lowest to the highest at the present, at the moment. You draw another line from the same lowest to the highest of the high, right? So you see, I notice the resistance of this level. Then I've noticed again the support of this level, right? Now I need also to indicate this. So pretty much it's been turning here. It turns the same place. It turns again. That the date was the 9th May. 10 at this place. Again, on the 19 May, it resisted this place. Again on the 25, again resisted this place. You can see the sign of hammer candlestick identifying that the trend is actually tired. Now it's starting a new trend, right? But how can we enter now? Now we already tactically, we already analyze, we already see the highest and the lowest. We can already identify where can we put our stop loss and the take profit and so on and so forth. So we come to a little bit lower time frame. Maybe let's go on a 1 hour. So we go on an hour. If you look at on an hour, the market is actually, pulling to drop all the way to this position, right? To this level here, where it's been resisting at a lot of time, right? That's where the market is actually, looking at it to drop to this level. So